Going back to high cap rates, why they're higher, and higher cap rates send the opposite message. They typically reflect that the higher perceived risk. So you've got usually a weaker tenant demand, older product, tougher location. That can be due to the year built. That can be due to the submarket, the tenant profile on site, any operational issues. And you're going to have just less buyer competition or limited capital targeting that segment. Or you may just have a heavy value add play where it's just a riskier investment. Hey everybody, Dan Brisse here. Welcome back to another episode of Keeping It Real Estate. Today we're going to talk all about cap rates. Cap rates indicate so much change in value. The slightest change in cap rates can change values up or down, and we're going to tune into them today and give some predictions that we think may be coming. The biggest thing that have affected cap rates these last few years is interest rates. As interest rates rose, cap rates followed. And when rates rose and cap rates followed, values went down. Unless you've been completely out of the loop on commercial real estate, values over the last few years have been hurt tremendously. You've got this period of time where expenses were high. You've got rents softening due to supply coming online. And you had interest rates rise tremendously as the Fed went to battle inflation, which caused the cost of money to increase, which ate cash flow, which means there was less cash flow left over for the investor. So you had to pay less in order to get a return. So cap rates are incredibly important in the commercial real estate world where we live, all multifamily and triple net. So keep in mind, cap rates are the heartbeat of real estate investing. I want to say that again. Cap rates are very similar to the heartbeat of real estate investing. They tell you how the market feels about risk and return, and it also tells you how much it costs to borrow money. But there's one of the most misunderstood numbers in the business from what I'm hearing when I talk to investors. You might say something like, take apartments, for example. Back in 2021, U.S. multifamily cap rates were around 4.7% on average. And by 2023, as rates rose and sentiment cooled, they moved into the mid 5% range. That doesn't sound like a big jump, but if income stays the same or potentially goes down, like a lot of assets have experienced, that kind of move can knock values down by the mid-teens in percentage terms. And that's the power of cap rates. It could reduce the value of a $40 or $50 million deal by millions of dollars. So this episode is about why cap rates are really telling you about risk, about price, and about where we are in the real estate market cycle. This episode is about what cap rates are really telling you. It's telling us about risk, telling us about price, and about where we are in the cycle. The market cycle is everything, you guys. So a little bit of context. Let's start with the basics. So cap rate equals net operating income divided by purchase price. If you hear that and you're like, oh my gosh, what does that possibly mean? Really simple terms, you guys. If a property has $1 million of NOI, which is just purely income minus expenses, take all the income minus the expenses, you're left over with the net operating income or the NOI. And it sells for $20 million, that's a 5% cap rate. You could think of it as the property's unlevered yield on today's income. That's a very basic way to understand cap rates. And it's a pricing signal of how investors collectively price risk and growth in that market. So a cap rate is really a snapshot of three things all at once. Keep these three things in mind. Number one is return expectations. So what unlevered yield investors are going to accept today for this income stream is the return expectations. Number two is the perceived risk. So safer assets and markets generally trade at lower cap rates. The nicer, newer product, it's all a tighter, lower cap rate, lower return, lower risk is how it's perceived. And then number three is just your market appetite. When the market is crowded like it was back in 21 with capital chasing deals, cap rates compress. When buyers disappear, they expand, which is kind of how we're experiencing it now. There's just less buyers in the market. It doesn't mean it's dead by any means. There's still many offers on some of these assets, but it's not like it was back in 2021. I'll keep coming back to that again. So cap rates are a pricing signal, not a full investment thesis. Just keep that in mind as we talk today. Again, low cap rates says something of what the market is telling us. Low cap rates, they're not magic. They're just simply a message that usually means very strong demand for the asset type or location, lower perceived risk, again, stable income, strong tenant demand, good location, durable fundamentals, often an expectation of future rent growth. Think about core, infill, institutional quality product in gateway markets. Historically, prime Manhattan multifamily has traded in the low to mid 4 cap range, with best in class assets occasionally dipping into the 3 to 4% band in frothier periods. That's investors saying, I'm willing to accept a low current yield because I believe this income is rock solid and will grow. So here's a key idea to understand. A 3.75% cap rate doesn't mean it's a bad deal necessarily. It means the market believes the income is safe and or will grow. Your job is deciding if that belief is justified and what the future may bring for that asset in that location. That's the part of investing, especially in real estate, that is challenging. So going back to high cap rates, why they're higher, and higher cap rates send the opposite message. They typically reflect that the higher perceived risk. So you've got usually a weaker tenant demand, older product, tougher location. That can be due to the year built. That can be due to the submarket, the tenant profile on site, any operational issues. And you're going to have just less buyer competition or limited capital targeting that segment. Or you may just have a heavy value add play where it's just a riskier investment. In many of the secondary or tertiary Midwest markets, especially for the older or value add multifamily, you might see cap rates in the mid 6s to high 7s or even as high as 8 or 9 if your market is unstable enough. Again, that's just simply the market saying we need more yield up front to compensate for the risk this deal has and the uncertainty around your rent growth or the liquidity risk when we go to sell is going to affect that. Here's an important nuance. A 7% cap doesn't automatically mean it's a steal. It might be fairly priced for the risk or even expensive if the story is weak. You go and buy a 7 cap deal because the cap rate's higher, but then when you get in to do the value add play, it's much more challenging. The tenants are much more difficult to manage and you can't move the income where you hoped it could. Whereas you could have bought a 6 cap deal and had much more NOI growth because you have much more control over the tenant profile. So higher cap rate does not necessarily mean it's just a better deal. Another point is that trends and movements and why cap rates move. So cap rates don't move in isolation. They live in an ecosystem. So interest rates, again, they affect it. Spreads affect it. Sentiment affects it and fundamentals affect it. So we're going to hit these 3 pieces in a little more detail. Again, going back to interest rates and spreads, cap rates tend to move directionally with long-term interest rates, like I shared at the beginning of this podcast, because investors look at the spread over risk-free yields and debt costs. Really simply put, if it costs more to pay the debt, if it costs more to pay the interest on the loan, there's less cash flow left over for investors. But the move is not 1-to-1. So sometimes rates spike and cap rates barely move for a while because the sellers are slow to adjust and buyers are underwriting stronger rent growth. So it's not guaranteed, it's not direct, but they're correlated. Rent growth and NOI expectations. If investors do expect strong future rent growth, they may accept lower cap rates today. And if they expect flat or declining NOI, they'll demand higher cap rates as compensation. So really, that's the projection of which way you think the market is going to go. And what's interesting about this is in the projections of which way you think the market's going to go, generally what happens, and we saw it back in 21, is that when things are good, people underwrite that they're going to continue to go good and you're going to have this incredible rent growth. So they're buying at a point in time where rates are relatively low and occupancy is high and rent growth has been strong. And the goal or the assumption is that they're going to continue to have that for the next 5 years or 10 years. Well, as we know, markets shift. They shift. We saw it shift in 2021 and into 2022 and 2023, 2024. And here you are in a period of time where rents have softened, income has gone down. So not only did you not get the 6, 7, 8, 9, 10% rent growth, you might have -2, -3, -4% rent growth from where you're at. And now 2-3 years later, you might be $300-400 below what you project, or even $500 per unit low compared to what you thought you'd be at. That's a problem. And that's when you have opportunity to buy. You might phrase it like this. Think of cap rates as the result of a tug of war between interest rates, growth expectations, and fear versus greed. And you can't explain them with just one variable. A quick case study, I'll share with you guys. We're going to make a real case study here in Dallas-Fort Worth market. It's a DFW market. Multifamily market cap rates have been creeping upward. For example, by mid-year of 2023, the median cap rate for multifamily in the region was 5.2%, up from 4.4% a year earlier. More detailed by class, you've got late 2023 for Class A assets. The range in DFW was roughly 5% to 5.25%. Class B was 5.25 to 6, and Class C was 6% plus in many cases. So here's how to think about this. Suppose you bought a Class A multifamily asset in DFW in early 2022 at the cap rate of 4.4%. 2 years later, in 2023, similar assets are trading at 5.2%. If your property's NOI stayed flat, for simplicity here, and it likely didn't stay flat, it likely went down, then the value of the property would drop roughly from a cap rate of 4.4% to 5.2%. And so at 4.4% cap, $1 of NOI would support $22 of value. At a 5.2, $1 of NOI supports $19 of value. Doesn't sound like much, but that's a drop in value of approximately 15 to 20%. And if this swing were even larger, say the move to 5.5 or 5.75 for lower quality assets, the value could have been impacted by 25% and more. And that's exactly what we saw. Over the last 12 months, we've seen cap rates in Dallas stabilize, and all of the current data is suggesting that we will see anywhere from 50 to 100 basis points of compression over the next 5 years. So just realize where we are in the market cycle, ladies and gentlemen, is where they are projecting cap rate compression as we're seeing the market, the economy struggle with jobs where the Fed has to lower rates. They're in a position where they have got to lower rates to stimulate the economy, or we've got another major job crisis on our hands, which is the thing that the Fed is most eager to prevent. So to sum it all up, you guys, when you see the market cap rate at 5.2% now, instead of say 4.4%, you're reading the market is currently saying, I'm going to pay less today for the property for the same income stream. So I'm paying less for the same passive income stream because I'm personally seeing more risk and less potential growth, or both. That's why it takes courage to buy when the market is down, and it takes understanding this information and economics to predict where are we in the market cycle about. And if we just went through 4 years of pain, 4 years of prices compressing, if we just went through 4 years of pain and prices coming down 20 to 30%, and now we're starting to hear the Fed say we got to lower rates, we're going to have to start dropping rates, it's very likely that we are bottoming out on this market cycle, and we have a nice 5 to 7, maybe 10-year run as we head into this new market cycle. Thanks for listening. I'm Dan Brisse. If you want more information about what we do, reach out to us at www.granitetowersequitygroup.com/contact us, and we'll look forward to seeing you there. Thanks.